Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome back and thanks for tuning in. It is not Phil Tarrant, it is Alex Whitlock here today hosting the show. Good to be back. I've got a guest here who I actually personally know and I've known for quite some time. This chap here has been really an outstanding investor. He has hit the ground running and has amassed a fairly significant portfolio in a pretty short space of time. His name is Mitchell Burge, or Mitch to his friends. He is an air conditioning engineer. He's built his own business. He's a self-starter. He's worked from the ground up and built himself a good business, but he's also built a very impressive investment portfolio over the years. Mitch, great to have you on the show.
Thanks for having me.
It's been a while since you've been on.
Yeah, it's been nearly 2 years, I think, now. It's gone quickly.
Yeah, indeed. So, whilst you've not been on SPI for a while, you've been quietly ticking away with your portfolio, constantly keeping it moving forwards.
Yeah, progress still keeps, but it gets easier as time goes on because it's more mature now. You don't have to do as much as you used to.
So just to recap and just to give people a bit of a snapshot of where you're at, you have a portfolio which is worth circa 8.2 million, which is very, very impressive.
Yeah.
That combines a residential portfolio of 16 properties, your own home, and you've got 2 commercial properties in there.
That's correct.
Just to give us a bit of an insight as to when your journey started, and I'd like to sort of look at where you're at now and where you're moving forward, but just to sort of get going, just tell us about your first purchase ever and what was behind that.
The first one was when I was about 20, 21, being a tradie and working with a lot of people around me a lot older. I very quickly realised the easiest way to wealth if you're not academically that switched on is property. So I saved from when I was 14.
So you got out, you left school at 16?
15.
15,
yeah.
Straight out, working, earning money.
Left on a Friday, started on a Monday.
Yeah.
Yeah, so I was qualified tradesman by 19. So, went straight into the place. I'd been saving since I was 14, put the deposit down, bought in the absolute worst part of the market, but as you know, time fixes that every time.
Yeah.
And it did. And we've still got that one. We still live in that place.
So this is in one of the suburbs just north of Sydney called Mount Colah.
Yeah.
What was the property that you bought?
At the time, it was a small 3-bedder on nearly 1,000 square metres on the National Park. And I picked it up for about $455.
Okay.
Within 2 years, saved a little bit more, did a basic reno. So I borrowed some more money, which back then I think the reno was about 60 grand. I did a lot more work than that. I coughed up a lot of the coin myself. And now it's doubled. It'd be just over $1 million.
Oh, I'd say so. Yeah, maybe a little bit more. Yeah,
maybe more.
Yeah. And I think just looking at how time factors into an investment value, going out and getting that property back then, saving your money, that's been really valuable to you in terms of helping to build your portfolio. We'll get into that in a second. But just going along and getting that first home has really been a very valuable step forwards.
That was probably the most important step I ever took in my whole life because it was very hard because I remember going to the pub and seeing my mates drinking their whole savings because I was only 20, 21. My mates would laugh at me because we'd go to the pub and I would be basically going there with $1.
Yeah.
And I'd put that dollar
That's
in the
not changed.
That hasn't changed. And I'd put that $1 in the pokes and hit collect and get my free drink and then out would come my home brew. So I'd pre-mix, but it's because I couldn't afford to and I had to work a second job and my mates would laugh at me. But years later, it was worth the sacrifice.
So, it's really sort of gives an indication of the way that you're wired. So you bought your first home when you were a young man. You spent a lot of time then, and we won't go into your business side of things, but you worked hard. You set your own business up. What year did you set up License to Chill?
That was 2007, I believe.
Yeah.
2006, 7. Yeah.
So a lot of your focus went, you got your home, you were paying down your mortgage. A lot of your focus and energies went into building up your business.
Yes.
So let's get into the investment side of things. So you began investing around 2013, 2014?
About 2014 after we went out in the boat.
Yeah, for a fishing. Yeah, went out for a fish.
Yeah, it was your fault.
So just, a bit of background. Mitch and I, we know each other through fishing. We went out for a fish. First time we'd been out for a fish, actually, wasn't it? We didn't really know each other that well. And just on the way, pulling back into the boat ramp, you were sort of talking about just putting some money into some shares and just sort of thinking about starting to put a bit of wealth away. And it was really a conversation where I sort of talked to you about the power of investing in certain sort of assets we were buying in Sydney at the time. And you being wired the way you're wired, you didn't just buy one property, you got stuck in and bought a whole range of them.
Yeah, I heard what you were saying at the time when we were in the boat and the figures, and just being in business, it just didn't quite balance in my head. And there was a place that you bought out near Penrith. And I went and saw that, and I saw the figures, and it all balanced. So I then started doing my research, and then when I realised it was actually real, I moved really quick. Within a year, I think there was 4 houses already.
So just a quick snapshot, just to give people a bit of a view of how things were in that particular area in Sydney, sort of out in Western Sydney. You'd got really quite high rental yields because you'd had sort of a very flat market for a number of years. So the rentals had kind of crept up, whereas the property values had stayed pretty low. So we were in a position where we were buying pretty much cost neutral properties. We were picking up places for sort of a couple of $100,000, apartments maybe a little bit less, and Mount Druitt and St Mary's, areas like that. So the conversation that we'd had was really around, the positive, or at least cash neutral sort of positioning of the properties with sort of fairly small investments. So, and this is where I want to bring back in just the groundwork that you laid with having your own home, because that was really pivotal in terms of enabling you, because you'd been paying away your mortgage very diligently. So you built up quite a nice little bit of equity in your own home. So this was really a launch pad for you to getting into investment.
Nothing could have happened without that home. Not my business, not the very first investment property, nothing. But it had become almost stale to the point I'd put so much into paying it down, and I was looking and doing the math of how much I could afford to pay it down. But then I was looking at the property market kept accelerating away, and I realised I could work very hard and be debt-free in another 4 or 5 years, or start using that money a little bit smarter. And I'm glad I took that turn, because that first place from when we went in the boat that I bought at Minto 2 months after that house I paid $260 for.
Yeah.
800 square metre block, 4 better. I bought in $340 a week back then in 2014, I think.
Yeah.
That house now, I've been offered $580.
Okay.
Yep. And the rent's now bringing in, the rent hasn't gone up. The yields obviously hasn't kept up.
Yeah.
But considering what I paid for it, for me, that's how I'm calculating the yield. It's working for me very well. I think I'm getting $390 a week now. When
you bought that place back then, 2014, where did you think, if I was to ask you back then where you thought you'd be in sort of 5-6 years' time, where did you think you would be for that first? How big do you think your portfolio might have been at that first purchase?
I never thought I'd do this.
Yeah.
No, it was exciting. As you know, it was like almost playing sport and winning. I wanted to talk about it too much back then, which I'm a bit more reserved with it now, but I never saw it going like this.
So you're now sat there with an $8.2 million portfolio. Just looking at some quick numbers, just from our chat before, you're looking at around about a 65% LVR. So it's not only a substantial portfolio, that gives you about $2.93 million worth of equity in that portfolio.
Yeah.
So this is a very, very, not just a large portfolio in terms of the value, but it's a very well balanced portfolio in terms of giving you the ability to leverage further off this. And this is something you've done very effectively, going from one investment property in Minto with your own home to now having 16 residential, 2 commercial, and your own home. So looking at where you're at now, you're sitting on a very balanced portfolio. What are you looking to do with this moving forward?
Well, at the moment now, with another little bub born and planning for quite a few more, we're now at the end game. I don't really want to buy too many more investments. At the moment, my wife and myself are just looking for their forever home, because ours isn't big enough anymore, and we're not going to sell ours. So we've put an offer on a house 2 weeks ago.
And you're still this is still the same place, Mount Colah, 1,000 square metre block, 3 better, yeah.
We'll never sell that. Everything started from that house.
Yeah.
So we'll keep that one in the family. And we're also creating intergenerational wealth, because I don't feel that my kids will be able to afford to do what I'm doing now. So we're trying to hold property in our area, so our kids don't have to move miles and miles away. Like most of my friends have had to move up the coast because they can't afford to live in my area. We don't want our kids going too far. So we want to hold as much as we can in that vicinity. But at the moment, we're looking at acreage. So it's a combination of land banking and buying for the future.
Okay.
And the property that we've just put an offer on, it's just under 20 acres. And I can tell you that within about 10 to 15 years, not that we'd want to, but you could probably carve it into acre blocks if you chose to.
So just to get some perspective on this is up to the northwest of Sydney, out from so you're in Mount Colah at the moment. It's a little bit further out from that.
A little bit further out, yeah.
What sort of time, just in terms of distance from Sydney, if you were to drive from the property to get into the CBD, how long would that take you?
Before traffic, being a tradie, I could still hit the Harbour Bridge in 45 minutes.
Okay, that's incredible.
Yeah, and you can still live on the bush and have cattle and live that kind of a lifestyle and have a dam 45 minutes from the bridge. What more could I want? And that's where the population's expanding to. So if you can get acreage out there, you just can't go wrong.
So without giving the actual postal address of where you're looking to buy, so you're looking at sort of something around sort of the 20 acre mark. How much are you going to have to invest into that?
Depends, because there's a lot of properties out there that might say they're 20 acres, but by the time you look at the zoning and find that it's a high fire risk and you can only build on 5 acres of it, a decent 20 acre block, you're not going to get any change from 3 mil.
Okay.
Yep.
So in terms of funding that, so you've got, just doing some rough calculations, you've got around about 2.9 of equity in your portfolio. Now, obviously, you can't take out all that equity. You've got to have some of it left in there. What's your strategy in terms of financing this? You've obviously got to, I know you're in the process of sort of researching and negotiating at the moment. You haven't found a place yet, but what's your strategy in terms of, how are you going to fund it? What sort of LVR are you going to look at? What's your move?
Well, there's one house on there up at Empire Bay on the water, and it's about, I think the value of that one now is about 2.3 mil. And that thing is a big cash cow. To keep that alive, I've got to put a lot of money into it.
So a bit of a snapshot. Was this the last residential place that you purchased?
Yes.
So just give us a bit of an insight into when you purchased it, what the motivation was behind that, sort of the nuts and bolts of the costs.
Okay. Well, sometimes you win, sometimes you lose. On this one, we took a hit. My wife and I wanted to move up to the coast.
Yeah.
And we bought a beautiful block on the water up at Empire Bay.
Yeah, this is on Brisbane Waters, just up on the central coast.
Yep, just over the Rip Bridge, and we paid 2.25, which for what it is a very good price.
And this was a 2,000 plus square metre block.
2,500 squares. Yeah.
It's a big block of land.
Big block of land, and we wanted to build the forever home on it.
Yeah.
The problem is we got our kids into private schools in Sydney and realised the transport just wasn't going to work. And we bought that in the end of 2017.
Yep.
And it's settling now. So we're taking a bit of a hit on that one.
So you're taking a hit. Is that in the costs it's had to hold it, or in terms of the actual value you're selling it for?
I've sold it. I've still got 75,000 more than I paid. But
okay, yeah. So it's really
our holding costs.
It's good that you view things this way because you've actually sold it for more than you purchased it for.
Yeah, but it's still lost us 157,000.
It's cost you money. Yeah, okay.
Yeah.
And one of the problems with that place, and I remember when you looked at purchasing it, it was very much a place for you to live. It had a very small house on it, on a large block, didn't it? So,
yeah. We were ready to bulldoze that, and we already had plans drafted up.
Yeah.
So that would have been a beautiful place, and the people that have bought that have done very well. But we've got to look at the bigger picture. So 107,000 we've lost in holding costs from the day we bought it to letting it go, including real estate agent costs and everything. But it draws up a lot of cash. That costs us holding costs about 5,500 a month.
Yeah.
So by removing that out of the equation, it releases a lot of cash to go elsewhere.
So the money that you're drawing back out of that purchase, that's going to fuel the deposit for your next purchase for buying acreage.
It's releasing about 400,000. And also, I'm not too sore about taking a hit at 157,000 because it's calculated and we take that hit right now, but we're buying back into a market that's even lower.
Yes, no. In our particular area around Sydney, it's a buyer's market very much for the time being. I think that good properties are always hard to find, doesn't matter what the market is. So you can't rest on your laurels, but we are in a situation at the moment where some of those good properties can just sort of sit around a little bit longer and maybe there isn't quite the same interest as when the market's a little bit warmer. So how long have you been looking to buy just for this next purchase?
I've been researching for about 6 months, but I'm already starting to sense a little bit of a change in the market. So I've seen a few decent properties hit the market and move within a month, which maybe 4 or 5 months ago we're just sitting there stagnant. I'm sensing a bit more confidence in the market, and I feel by Christmas it's going to change. So
what would be your strategy? You've got your own home, you're going to buy this acreage. So how quickly will you look when you find the right block to move into this, or how are you going to manage that in your portfolio? Well,
there's a lot of things I need to do to clean up in our house, but I'm not doing it because I'd rather do it when it's a rental, so it's a tax deduction.
Okay.
So I'm going to rent it out as is with promises to the tenants to do everything, and we'll move immediately.
Because it's a more tax efficient way to go about doing that, to start the work once it's an investment property.
Absolutely.
Yeah.
So there's about 10 or 15,000 we've got to spend now to make it clean it up a little bit, but it's just not worth our while to do right now. You can't claim it. It's not a rental property at this point.
So, and again, just looking at your portfolio of the 16 residential investment properties that you've got, just give us a bit of a view of where they're located. Just a sort of an overview of...
there's 9 in Brisbane.
Yep.
And the rest are all in Sydney, 2 commercial in Sydney. They're kind of spread out. So we've got western suburbs
Yep.
through down to Windang, just past Wollongong, a couple of commercial properties in Thornlea in Sydney, one in residential in Mount Colah. So, and a kind of a mix between residential and land, but I much prefer land.
And in terms of the commercial properties, just give us an idea of when you purchased those and fitted those into your portfolio.
The first one was bought in 2014, which was an absolute bargain. I remember the neighbour abusing me because they paid $560, $570, and at that point, commercial market was down. I paid $308.
That's incredible.
Yeah, but then I bought next door, and I paid $560,000 for it for exactly the same.
Exactly the same.
Yep.
Wow. Okay.
So that's how much it's recovered by. But I needed that property next door, so I couldn't bargain on that. But it was still a good price, but there was no movement on that whatsoever.
So it's sort of a circa 1.2-ish value of commercial property, even though you didn't sort of pay that kind of rate. So that's...
Well, commercial's great because commercial, once you get a tenant in there, they really don't want to go. You can charge a much higher rent for commercial, and it's with most commercial, it's expected that the tenant has to pay all the associated fees, the levies, everything that goes with it, all the strata fees. Well, residential, it's a lot more swayed towards a tenant.
So these commercial properties, you're familiar with them. So rather than sort of deciding that you're going to go and buy commercial property and start scouting around, you saw an opportunity because you know the area.
Yeah.
How did you get to hear that the first one was up for sale, and how did you get to find out that was going for such a low amount of money?
I didn't. I was just looking in the area. I knew the market was down. I heard everybody saying how bad the commercial market is, and my ears pricked up. So you can only throw so many stupid offers before somebody takes one.
Yeah.
And that's all it was. It was just a volume. I must have put out 20 offers before somebody took one. And I'll tell you what, if I bought it for 300, the next year it recovered to 400. You can make more money out of that than you can at work.
So with such a substantial portfolio, Mitch, and you've got many, many properties in there, how do you go about managing all of the repayments, just balancing up all of the various commitments that you've got, making sure that you keep all your insurances and so forth up to date? Because it's a pretty significant portfolio to manage.
It is. You'd be surprised how much money moves through the accounts on managing them. It's a job. And it actually genuinely is a job, because there's two ways you can run it. You can hold the receipts in a shoebox and hope your real estate agent does their job. But I can tell you at the end of the year, that's not going to work for you. You need to forward mitigate. We've got a great accountant, Munzrel, from Gershab Accounting, and he's helped train my wife. So my wife works in the business.
Yeah.
And she's also got a second job running the portfolio. And everything's on spreadsheets. Everything's costed. She knows exactly when the rent's meant to come in. She knows exactly what the LVR is on every property. There's not a question I can't ask that's not there straight away. And it's a job, because Munzrel set us up properly. So we've got trusts, companies, subsidiaries. It is a business, and a business is meant to pay a wage. And it does.
Okay.
So that's her job, to run the portfolio, and she does it really well. And just little things like managing the real estate agents. Some real estate agents are really sneaky. If you haven't had a lot of problems for a while and they've got a house...
We're talking about the property managers.
Yeah. We do a lot of work for hundreds of real estates. Most of them are great. But occasionally, the rental rolls that they have now is just not manageable. It's not uncommon for a manager to have, say, 400 lots. They can't do it. So they pay attention to the top 10, 15%, which screen the loudest, and the ones that don't. I've personally witnessed where I've paid bills for other people where they don't want to deal with it. So we manage everything. And one of the tricks that we've found, we don't give any approval for anybody to go to a property and do anything without calling me, because I'm a tradie. I want to hear what it is.
Yeah, that's interesting. Yeah, because the usual practice is that you'll maybe give an authorised amount that they can go and, spend on your behalf, or you'll get an email through or a call from the agent saying, does this particular work done? So you're very hands-on in terms of checking on everything that needs to be that's requested.
See the difference in our figures. So, for example, if you give a max figure, I can promise you every tradie gives you the max figure. Or if you tell that tradie, I want a free quote, that tradie's got to feed his family. He's not coming out for a free quote. That's just factored into your job.
Yeah.
So what could have been a $200 fix on the time, he's just put $200 onto his quote that was only $200. It's just cost you $400 plus tax. So managing those things on a big portfolio at the end of the year properly makes a huge difference.
Yeah, I think one of the pitfalls for new investors going into buying, particularly sort of older property with where there's potential to renovate or sort of upside in terms of getting good cash flow, is the amount of work that needs to be done on older properties. And I think that one of the biggest problems is that you can underestimate how much work needs to be done. Or if you don't manage it properly, you can end up paying out for jobs that maybe the tenant should be taking care of themselves. So yeah, it's quite an easy way for leakage in terms of your investment.
Yeah, we got an invoice last week that we didn't authorise, and then it just happened to be for a property through somebody else. The agents make mistakes.
Oh, really? Okay.
Yeah. This happens to us all the time. And if you're not on it, that could have just gone in the to be paid file. And that was nearly a $1,200 invoice.
Wow.
Yeah.
So all of your properties are managed?
Yes.
And for the commercial ones, do you manage those yourself, or do you have an agent that manages those?
Those I manage myself.
Yeah. Just in terms of your, the debt that you've got on these properties, have you got some fixed interest rates? Are they all variable?
Yeah, I sat down with Ross from Aussie a long time ago, and we've got some that are fixed, some that are variable. But for example, my home, that is variable, and I sit a large amount of cash in the offset account.
Yeah.
So pretty much every payment goes straight off the principal. And once we move and that becomes investment, I'll do the same elsewhere. I found that a very good trick at knocking off debt without paying it down. And that way you're still holding cash. So if you hit bad times, you can get to that cash very easily and it's still working for you.
So you've got a very clear strategy, and this isn't just about building a valuable investment portfolio. This is going to be a leverage and an opportunity for you to build the home of your dreams in the area you want to live. But just looking at the actual investment portfolio moving forwards, and you are now 36, 35, 36, yeah. What are your long-term strategies in terms of your investment portfolio in conjunction with the business that you run, in terms of enabling you to do the things you want to do later in life? What are your sort of plans at the moment?
Well, it's funny because I wouldn't even have a business if it wasn't for the property. Because in 2007 on the downturn, business went down quite hard. And it was just because I'd paid off so much of the house that I could actually survive off some of the money I'd put aside. But at the moment, once we get this house, we just want to stick with the property. We don't want to buy any more. Okay. We just want to put money in the offset and just sit back for a while. I think it was Warren Buffett said sometimes it's the hardest thing to do, but the best thing to do sometimes is nothing.
Yeah.
And the animal's quite big now. If I do nothing and it doubles in 10 years, that's $8 million. And the hard work's done. All we now need to do now is just hold it. That's it.
So you've got a couple of strategies. There's various options with the portfolio. And at the moment, sitting at 65% LVR, it's a nicely balanced portfolio. You can either sit on the portfolio, wait for the rental yields to go up and start to, and to pay down the debt. That way you can sit in the portfolio, look at it doubling in value in 10 years' time, which is not an unreasonable thing historically. And then you can sell off half and pay off the other half. Do you have any other investments? Do you look to buy into mutual funds or the share market?
I've looked at the markets. The problem is the world is just a volatile place right now. And even yourself, who I've spoken to, and when we're out in the boat with my cousin the other day, you remember?
Yeah.
It's just so volatile. I'm old school. I need to see bricks and mortar. Eventually one day we will, but at the moment property's just working for me. So, and it's a simple plan. It's an easy plan and it's working. So at the moment we just want to get that debt. I want to get the new house. And in the next couple of years, I want to get that LVR down to 50.
Okay. And in terms of, your work-life balance, which is, I know a focal point for you, do you have a goal for when you want to be able to step back from business or maybe spend more time at home, or have your investments start to generate some wealth for you?
Yeah, I've already actually stepped back a little bit. I'm surrounded by really good people at work. My 2IC, my general manager, I've worked with her for over 10 years. Really lucky in that way. So the team's getting better and better and the company's doing great. So at the moment, I'm sort of doing 4 days a week and spending more time with the kids. And as the years go on, I'll be doing more of that.
So just what would be your advice to anyone out there who's maybe looking to get a foothold in the market? It doesn't really matter sort of what stage of their life they're at. What would be your advice to people to sort of, and this is with experience, how would you suggest people should view the opportunities in terms of building an investment portfolio?
Well, there's two kinds of people out there, lifters and leaners. You can be a leaner your whole life and complain about why you didn't get that house, or you can just do it. And a lot of people I'm finding now really want to have the forever house straight off. No. If I had to start again right now as a younger generation, say 20, 21 or 25, whatever, I would totally accept that I wouldn't be living in the investment. I'd be leapfrogging. I'd be looking for neutral yield, closer to positive, and I'd be chasing the yield more so than the area, knowing that I've got time on my side and eventually that'll catch. And then say in 4 or 5 years, you've got enough equity, do it again and again and again. And that would be the best way to then leapfrog back into the Sydney market. Because you can imagine if somebody now went and bought $1 million place, which doesn't even buy you much in Sydney, and they're stuck paying those repayments off the bat, it could cripple them. This way they can end up with $2-3 million worth of a portfolio very quickly, very easily within 4 or 5 years. And it's not really costing them anything to hold. And once that doubles, you can leverage back into this market.
You've given us a really good insight into the property that you bought on Brisbane Water on the Central Coast, which, you know what, in the greater scheme of things, it wasn't disastrous, but you said that was probably sort of one of the toughest ones. In your mind, what was your best purchase out of all the properties that you've purchased over the years?
Probably my home.
Yeah.
Because it got me, I was a kid, got me disciplined, forced me to work a second job. I also told the bank I earned a lot more than I did back then to get the loan, so I had to refinance it straight away. So I knew that if I missed a payment, I'd be in a lot of trouble. It's a lot harder now. You couldn't do that. That home was just the fortress that set up everything. And from there would be the second one, Minto. The one that straight away, that place has just been a raging success, that one. I never would have foreseen that happening. I just wish I knew what I know now back then. I would have bought 10 of them.
Yeah, well, I've said before, myself and my business partner, Phil, we've got a combined portfolio with us, which we showcase through Smart Property Investment. Our combined portfolio is worth about sort of 7.2, 7.4. And we sat in auctions and we've walked away for buying properties out west, in St Mary's. I remember we went to an auction in St Mary's and we purchased a 3-bedroom property for $215,000, which is just crazy, back in about 2012. And we walked away from 2 others and they went $1,000 over our limit and we walked away. And hindsight is a wonderful thing. You can go back and say, I wish I'd bought 10. But you know what, Mitchell? One of the things is, and one of the reasons why I think that you are sitting on a 65% LVR portfolio worth circa 8.2 million is you've been cautious. And I do know you very well, and you are a cautious man. You're not, that doesn't mean to say that you're not willing to take calculated risks, but you are cautious. And yeah, it's easy to look back and say, oh, I wish I'd bought this and I wish I'd bought that. But I think oftentimes, these are the people that you sometimes interview where they've lost everything because they've stretched themselves too far.
But it also helps having a good circle around you too. Like I chat to you. Also, Steve from the Right Group, he's been brilliant. He's been there since day one. So if I ever get stuck, because sometimes your emotions will get away from you where you think, oh, is this a good move? Is it not? I find it really helps to have a circle of people like that around you that you can just pick up the phone and go, what do you think? And get a non-emotional view.
So that circle in your case is your accountant, who has been central to helping you structure the portfolio the right way.
Yes.
Your buyer's agent, who has helped you in all the purchases apart from your own home, and then apart from the
even the one I bought up the coast. Steve from the Right Group's helped me so much.
Yeah.
There was nothing in it for him, but he still helped me on that. I still call him every second month just to touch base.
So your accountant, your buyer's agent, and also your mortgage broker.
Yes.
These are the team that you have around you. And in terms of a conveyancer, have you used different conveyancers for different areas?
No, I use a Shook. I can't remember where he's from, but he's been absolutely brilliant. So I've got a very tight-knit team and I chat with you regularly as well. So that's been a big help.
Mitch, it's been really, really a great pleasure catching up with you. You've done outstandingly well, to have a portfolio of that size in such a short space of time, so nicely balanced, is an outstanding achievement. And I'm really grateful for you being so candid and sharing so much about your portfolio. For everyone else, thanks so much for tuning in. It's great having you here. If you've got any stories you'd like to share with us, we would love to hear from you. It doesn't matter if you're gearing up for your first purchase, if you've got a substantial portfolio, or if maybe you've just made your first step in the investment market. Get in touch, let us know. Contact us at editor@smartpropertyinvestment.com.au. You can reach us on all the usual social media. We're on Facebook, we're on Twitter, and don't forget to check out all the latest stories on smartpropertyinvestment.com.au. Thanks for tuning in.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.